young people and so on. Nobody signed the right documents, and at the end of the day, there was several major lawsuits as a result of that. Of course, Facebook is 1 in a trillion. I don't know what. How often Facebook? I guess never. Facebook happens, except for once. But but that's really a good example of not having the proper documents in place at the beginning. So, with that introduction, I will turn things over to Jeff. You will.
Thanks very much. It's like Richard, I'm really pleased and honored to be here. And this is my second time at this campus, and I'm just blown away by it. I'm going to get a tour, I guess, of some of the clean rooms later, which I'm really excited about. I'm particularly impressed not just by the the physical facility, which is really impressive, but all the incredible programs that you have going on here. It's just I was saying to Michael a few minutes ago that I'm involved in a lot of things at MIT, the MIT Venture Mentoring Service, which is a group of experienced entrepreneurs that mentor a pipeline of MIT-based startups, the stuff that's going on here is way more entrepreneurial than the stuff I see even at campuses that have a really huge reputation for being hotbeds of startup activity. So hats off to this place. So my topic is money. Where does it come from? How do you get it? What terms can you expect to get it on? I'm going to talk about this topic generally from, and do so more or less from the perspective of the party that's seeking money, the entrepreneurs, the young company that needs funding. After speaking kind of generally about this, I have a couple slides on the financing environment and clean tech specifically. So I'll say a few words about that. So what are the range of funding sources that are available to a startup company? I'm certain that many people in this room, this is this stuff cold. But for those who don't, maybe you're thinking about starting your first company. Entrepreneurs in the very early stages these days, it's very typical for some often considerable period of time to essentially bootstrap your company. And that means the founder's credit cards. It means it means small investments from friends and family. And oftentimes it's there aren't other choices early on. As everyone well knows, since the tech bubble burst about a decade ago, the landscape for venture capital investment has changed a lot, and it's become something of a truism that there's not a lot of venture capital available for very early stage stuff. Now, I personally see that there is that money is still available. And I'll talk about angel investors in a minute. The angel investor groups have become very sophisticated and have filled the funding gap to some extent. But there are even VC programs. Charles River Ventures, for instance, in Boston, has a quick start program where they'll loan up to maybe $250,000 or $500,000 on very simple terms very quickly if they get an option on doing your A round. Highland Capital Partners has a similar program. But there are way more startups out there trying to get launched than there is money available at this early stage. And so you see a lot of entrepreneurs by necessity and to some extent by design bootstrapping very early. This is also the age of lean startups. Entrepreneurs who are inclined to try to grow their businesses to a certain stage, with very little capital, because they know that when they do raise money, if they've succeeded in getting out of the development stage and beginning to enter market and have begun to amass a good team, some of these success factors that Richard talked about, they're going to get better terms from the venture capitalists, in addition to being able to, be more attractive to them. And really, it's kind of those types of criteria that most venture capitalists are looking for in terms of reaching sufficient maturity for funding. And friends, founders, family, tend to invest on very simple terms, just buying common stock, or perhaps taking a page out of the angel investor's book and maybe investing through a convertible debt instrument. And I'll talk a little bit more about what that means. Angel investors tend to be wealthy individuals, but wealthy individuals who've kind of done it before. They're often, tech or IP-centric company entrepreneurs. They may have had multiple companies, multiple exits. They're not really interested in doing the operating company thing again, although some of them are still, very active as executives in companies they founded. And they either invest individually or through organized groups. And there are many prominent and exceptional organized angel groups throughout the country. Silicon Valley Angels is a leading venture angel group in the Silicon Valley area. We have several in Boston. There are several in New York. And these days they're very, very sophisticated. I started my career 25 years ago out in San Francisco, and saw how angel investors operated in those days in Silicon Valley, and it tended to be very, very different. One of my funnest young clients was a company called Phrox that nobody's ever heard of, but it did something kind of like Sonos does now, if you know the Sonos stereo systems. And it was founded by Andy Hertzfeld, one of the Apple founders. And they raised a bunch of angel money, mainly from rich Germans at the time. The president of Germany and his brother were among our investor clients in this company. And the terms were not as refined as they tend to be today. Angel investor groups will really take diligence seriously. They'll collaborate to construct boards for the companies to really monitor the investment well. And sometimes they'll invest, as I'll talk about in a minute, in convertible debt instruments, but sometimes they'll actually skip that stage and go right to a VC-like A-round structure, and I'll talk about what that structure looks like as well. Venture capital firms, we're all very familiar with, I'm sure. In the clean tech sector, they tend to be kind of fall into one of two camps. There are the general venture capital firms that also invest in IT companies, healthcare companies, a firm that's fairly omnivorous, that has one or two partners focused on clean tech. And then there are the clean tech specialist VC firms, Good Energies, Rockport Capital. And then there are actually some firms that I think have kind of exist somewhere in the middle at the moment. Kleiner Perkins is that way, I think. It is still an omnivorous VC firm, but more and more of its energy and capital is devoted to clean tech these days. It's hard to say whether they're generalist or specialist at the moment. Corporate strategic investors, these are big companies that have venture capital programs. Intel is the most famous corporate strategic investor. The company I was part of, I was on the operating side for 6 years. A company called Groove Networks, a software company, and we had Intel and Microsoft among our investors. In the clean tech space, I represent a company called SAIC. which is actually a big defense contractor, but it's got an interest in clean tech, and I've helped it make clean tech investments. Dealing with corporate strategic investors is much different than dealing with venture capital firms. They're capable sometimes of helping you in lots of ways that venture capital firms can't. They can help you with your R&D programs. They can help you develop a channel. They can sometimes provide money that's non-dilutive, like non-recurring engineering payments, you know, as you jointly develop something together. But it's always a bit of a dance with a corporate strategic investor from the company's perspective. With a pure financial investor, you kind of know what their motivations are. They just want to make a lot of money. With a corporate strategic investor, they probably want to make a respectable return, but they may have other objectives. Many of these corporate strategic investors invest in companies that they think are likely, you know, acquisition targets, and so you have to be very careful in negotiating the relationship with those types of investors, that you not sort of dampen bidding dynamics in your exit down the line. You don't effectively give them an option on the company. Another big source of funding, obviously, for clean tech, although you know, many of these type of funding sources can be hard to access, is government funding. And of course, government funding, when you can get it, is wonderful because it's non-dilutive. They're not going to take a chunk of your company typically, although some types of government investors do. There's the intelligence agencies have a quasi-venture capital arm called Incutel, and Incutel typically takes warrants in your company when it gives you money, so it actually gets a kind of equity piece. Let's talk for just a minute about typical angel investment terms. As I said earlier, more and more you see angel groups sometimes investing in preferred stock, as venture capitalists do. But a very common sort of angel investment structure is debt that's convertible into preferred stock when a venture capitalist comes along and leads the A round for your company. Often the entrepreneurs prefer getting money this way early on because you circumvent the very difficult challenge of establishing a valuation for the company. Oftentimes entrepreneurs think that their very early stage company is worth, you know, $10 million or $20 million or whatever, and from the investor's perspective it's, you know, maybe 1 or 2 or 3. And with debt, you get to kick the can down the road and let somebody else establish the valuation later. Typical terms for this sort of debt, you know, these days you might see interest rates in the 7 to 10% range, which is kind of a risk premium interest rate, if you will. Although some programs, you see debt that interest rates that are much lower. Silicon Valley Angels, I think, is investing currently at like a 2% interest rate. Basically, they're saying we're not interested in the interest, and most angel investors really aren't. Typically, the loans are repayable in 12 to 24 months, with the predominant norm being more towards the 12 range. Usually, they get to convert at a discount in the A round. So if the VCs pay $1 per share in the A round, the angel investors might pay 80 cents a share at the time of conversion, or 75 cents. They might also get a guaranteed return if the company is sold before they have a chance to convert. Usually a couple times the principal amount would be the guaranteed return. And there might be some what's called price cap engineering to basically make sure that they do well in in scenarios where the A round valuation is not that high, or the or that they do better than 2x if the company knocks it out of the park and